Hello, and thank you for tuning in to the Insight is Capital podcast. I'm Pierre Daly, managing editor at advisoranalyst.com, and today we're going to be talking about what has aptly been described by Nobel Laureate William Sharpe as the nastiest, hardest problem in finance. There's a massive and growing wave of the population expected to start entering their retirement years. Canadians who reach the age of 65 are living longer now than they did 50 years ago. However, they're also retiring slightly earlier, meaning that Canadians are retired for more than 40% longer today than they were 50 years ago. A confluence of factors has created a considerable misalignment between human and portfolio longevity that requires new thinking and innovative retirement solutions. To put it mildly, too many retirees live in fear of outliving their nest egg. Guardian Capital made quite a splash recently, announcing their partnership with Dr. Moshe Milevsky to develop a suite of retirement decumulation solutions to address the quintessential retirement dilemma, which combine compelling income and growth strategies of targeted yield and return asset decumulation in what is definitively described as a modern tontine. So I'm excited to have both Barry Gordon, Managing Director, Head of Canadian Retail Asset Management at Guardian Capital LP, and Dr. Moshe A. Milevsky as my guests to talk about these timely solutions and how they combine to solve the most classic of all investment industry dilemmas. Barry Gordon is the Managing Director, Head of Canadian Retail Asset Management at Guardian Capital. His mandate includes the responsibility to develop and execute the firm's strategy in respect of the origination, distribution, and marketing and operations of investment solutions addressing the needs of retail investors. Barry began his career in the financial services industry in 1997. Just prior to joining Guardian, he was a partner at BlindSpot, making investments in early-stage wealth tech companies. From 2003 to 2017, Barry was the co-founder, president, chief executive officer of First Asset Capital Corporation, which he successfully steered throughout the retail landscape. Under his leadership, First Asset evolved into a competitive, independent Canadian ETF company. Upon acquisition by CI Investments in 2015, it managed over $3 billion of assets. The firm continues today to formulate the core strategy for CI's ETF business with more than $8.5 billion in assets under administration. Barry has a law degree from the University of Toronto and an undergraduate degree from Queen's University. Dr. Moshe A. Milevsky, Ph.D., world-renowned Schulich School of Business professor, is recognized globally for his thought leadership in mathematical finance, retirement longevity, and tontines. His most recently published book, his 17th, is the culmination of many years of research and thinking on the subject, released last year, aptly titled How to Build a Modern Tontine. Dr. Milevsky brings a wealth of knowledge to the Guardian team. As Chief Retirement Architect in collaboration with Guardian Capital LP, he has helped structure GuardPath longevity solutions to address the very real challenges faced by retirees.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Barry, Professor Milevsky, welcome to the show. It's both exciting and an honor to have you.
Thank you. Thank you very much.
So, gentlemen, to kick things off, tell us about the arcs of your careers and how you each got into your respective fields in finance and professor in academia, and what you're working on together these days.
Well, I'll let Barry start since he is so much older than me. And I was going to let you start because your credentials are so much more impressive than mine. I mean, Pierre, I think you did a wonderful job of encapsulating my career. As you noted, I was a securities lawyer very early on in my career, and quickly decided that I was more interested in sitting on the other side of the table. Don't get me wrong, the legal training was invaluable in the development of my career. Investment finance has always been something that fascinated me from a young age, and so I migrated into the investment industry. Together with people who are far smarter than me, developed a really successful set of ETF offerings at First Asset, and the rest is history. I became fascinated with tontines back in sort of 2017, 2018 after I left CI, and which, culminated in the discussions with Professor Milevsky and onwards and upwards from there.
Well, Pierre, my day job is teaching undergraduate and graduate students at the Schulich School of Business at York University. So that's my full-time occupation. I get a little bit of time off to get myself involved in real-world projects, keep my foot in the real world. And when Barry reached out to me a couple of years ago saying, hey, we really want to build this thing. You've been writing about it for 15 years, but we can actually build it. I said, yeah, sign me up. And, given his extensive experience actually getting things done, I was excited to get involved. I often joke that the distance between the blackboard and the shelf is hundreds of miles. I could write an equation on a blackboard and say, this would be a great idea, but to get that from the blackboard to the shelf requires people like Barry and his organization and his team. So that's sort of the background.
Wonderful. Thank you very much for sharing that. Among the things we're going to talk about today, we're going to be talking about the Tontine. What was the genesis of Guard Path Longevity Solutions? How and when did you first realize, perhaps this is for you, Barry, that this project needed to be brought to life?
Sure. And I just touched on it in my previous answer that, the longer version of it essentially is that, I, in my, research in my time after I left CI, realized that, the biggest challenges and opportunities in the Canadian marketplace and probably internationally is to create solutions that address the needs of retirees, that the solutions that help them accumulate wealth are not well suited in this day and age to helping them decumulate. So in other words, spend their money in retirement. So we've conducted extensive research on these challenges and how advisors and investors feel about them. And there's, two major problems that need to be addressed. One is, high levels of consistent, distributions in retirement that actually are, decumulation. So people spending the money that they've made in order to enjoy their retirement. And second problem is the concern, the real fear around outliving one's portfolio. And so, the concept started with trying to address those challenges. And, the reality is that I wanted to be aligned with an organization, in Guardian Capital that had a, impeccable pedigree in institutional investment management over, 6 decades. And that it was going to be critical in order to bring these types of solutions to market, to be aligned with, to work with, people in such an organization. So, really, that's the long-winded background. And then, as I stated, early on, just before the pandemic, so really at the beginning of 2020, I reached out to Moshe and said, I'm really fascinated by this. I would love to get together. And, ironically, we were scheduled to get together in person the week after the pandemic started. So we had our first meeting by, remotely by phone, and then continued to develop the concept and started working together officially in just over 2 years ago, I believe. And have been, diligently bringing these solutions to life ever since.
Fantastic. And just, we had a conversation last year with David Blanchett and Michael Fink from the American Institute, and on the subject of decumulation in particular. And we also touched on the subject of tontines, but the subject that was more important in that conversation was that aside from, the obvious risks that retirees fear, are concerned with or face, there's also the behavioral problems as well that come along with that, right? I mean, I think one of the problems that comes along with decumulation is the acceptance by the retiree or by the investor that they actually have to deplete their investment accounts as part of the decumulation process, or setting up, traditionally, I mean, I think advisors have spent a great deal of time, figuring out workarounds to what the tontines actually solve. But, systematic withdrawal plans, that are more aggressively invested. I mean, all sorts of work, that don't necessarily work. They work on paper, but they don't necessarily work in reality. Or, as I said, there's the line item behavioral problem every year of the client coming back and saying, I don't really feel comfortable doing this or withdrawing all this money every year. Come hell or high water, no matter what happens in terms of sequence of returns and annual returns in the market. But that obviously can be very detrimental. It's a fully justified risk. And I say that because we're in the, I think that's even a bigger concern right now, because we're in the midst of really what appears to be a historical regime change following, 40 years of declining government bond yields into a new regime that definitely doesn't look like it'll be as friendly to investors as the last, coming from not historically high interest rates, but historically very low interest rates, and now rising from that historically low level, as well as the inflationary and market volatility that investors are facing, could end up being a very trying period, especially for those nearing retirement or who are already just retired. Because of the sequence of returns, risk, and market volatility. I could see where that problem would lead to people holding off on making withdrawals from their retirement pools, and then sacrificing sort of the enjoyment of retirement because they're in fear that it's the wrong time to take the payments, right? So that's what GuardPath addresses. I think having looked it over, maybe we can talk about how the GuardPath suite or the solution, the longevity suite, addresses these problems.
Sure. Well, there's I'm going to pass it over to Moshe in a second. I mean, there's really two aspects to your point and your question, which is one, the behavioral element of it, which, Moshe's done extensive work on, and I'm going to leave it to him to talk about. The second is how, you actually manage these types of solutions to try to ensure that, the sustainability of distributions and long-term returns. And so anyway, so Moshe, do you want to talk to the first part about behavior?
Sure. Yeah, right. Obviously, behavioral economics is very hot right now. 15 years ago, 20 years ago, that word didn't exist, or certainly didn't have the awareness that it has right now. And now one feels that every conversation about investing has to include the phrase behavioral problems before one goes on. So, let's do that. Let's give it its token. I'm a little bit uncomfortable calling something a problem when it's human nature. Problem means solution. Well, that's a problem, so I'm going to solve it for you. It's human nature. We don't solve human nature. And I think the second issue is that we don't want financial advisors with CFA designations or CFP designations or, Canadian securities institute suddenly saying, well, and I'm a psychologist too, because I solve behavioral problems. I think that there's a little bit of a risk there, but you're absolutely right. You touch upon something very important. As Dave and Mike, who I know very, very well at the American College, have talked about, when we reach retirement, we treat pots of money very differently, even though their present values are exactly the same. That's a behavioral oddity. So if I give you a pension, an annuity, a lifetime payment, whose present value is $1 million, and I give you $1 million, whose present value is $1 million, so the net present value of both of these pots is $1 million, you behave completely differently, even though the asset on your balance sheet is $1 million in both cases. When I give you a lifetime payment, a pension, a lifetime income, you tend to spend a lot of it. It's coming in, you spend it. When I give you $1 million, it freezes you. A good friend of mine, Tom Hegna in the U.S., says that assets make retirees miserable. Assets make people miserable. Like, what am I supposed to do with this? How am I going to? And what a lot of people do, there's research in Australia in their superannuation system, is that they just spend the interest. They spend the income. They spend the dividends. So they have $1 million, and if this year it's a good year and they got a lot of interest in dividends, they spend it. And if they got less, they spend less. And they're trying to stabilize their wealth, and their income is very volatile. That's an oddity. That's an oddity. And one of the nice things about these solutions, which Barry can talk about, is that they enable people to convert the $1 million in wealth, present value, to periodic income, which they're more likely to spend. So I think the behavioral aspect was part of what drove the design. And not to get too ahead of ourselves here, but one of the things that we felt in structuring this was that this problem of retirement over a long unknown horizon is not only terrifying and scary, it's just too far in the distance to visualize. To make decisions now that will help you in 35 years from now. I mean, I can't get my teenager to think about next week. We're going to think about 35 years from now. So part of the idea here was to convert the problem into two distinct segments. Let's take care of you for the next 20 years. And we're going to give you a reasonably stable fix. In 20 years from now, which is very hard to see today, what's the world going to look like? In 20 years from now, there's going to be a fairly large pot of money. In fact, a much larger than you think because of mortality credit. And then you can decide what to do with the next phase. You want to buy an annuity, buy an annuity. You want to buy a long-term care. You want to move into a nursing home. You want to give it to the kids. Let's separate retirement into the horizon you can see and the horizon that's very, very, very distant that you don't really want to commit to today anyway. And I think that, Barry can fill in the contours of how the mechanics work. But that was sort of the vision, all, Pierre, to deal with the point that you made. People have behavioral tendencies that we want to somehow take into account.
And if I can,
and they don't like seeing their, as you said, Professor, they don't like seeing their balance go down, and so they don't. So it's not that they don't want to do it; it's just they don't want to be in control of it. They don't want to be the one to pull the trigger every year and say, "Okay, let's take that 4%."
Yeah,
because or we're down 20% this year. I don't want to take it.
Yeah. So right? If I can supplement what Moshe just said. So when we were looking at this, from the behavioral aspect, we very specifically wanted to try to develop tools that advisors can use to actually help their clients plan for this uncertain horizon. And so, and the behavioral aspect of that is exactly what you're pointing to, which is traditionally, people have a portfolio and it's all geared towards, earning, you've used 4%, right? And so what happens is they get anchored on that 4%, the short-term returns. And so advisors spend huge amounts of time folding hands for clients who are focused on their worst performing line item month to month, quarter to quarter, instead of having long-term goals and being able to measure their long-term success by, against those long-term goals. And so having tools that actually, address that uncertainty, that fear, is what we were striving for. I think of it as, in an analogy, it's like we own cars, so we have these assets, and nobody wants to live with the uncertainty of, geez, when is my engine going to seize up and I'm going to be stranded on the side of the road? And so what we do is we have programmed, scheduled service intervals where we take care of the vehicle. Those are the tools that we have as people to reduce that uncertainty, that fear of, getting stranded on the side of the road. So, again, by analogy, what we're trying to do, the why of what we're trying to do is provide these tools to actually address some of these issues and help advisors, help their clients to set these longer term goals to, de-anchor them from that troublesome day-to-day fear.
Exactly. So you're not getting in your car every day worried about when it's going to break down every time you drive.
Exactly.
So in that same analogy, to make the analogy, I think a lot of retirees aren't enjoying retirement because they're caught up in this juggling or this tightrope of walking the tightrope of are we going to be okay this year? Do we have to wait? Should we make, I don't know. So if you can eliminate that line item risk that you've talked about, Barry, you're really creating a situation where the person whose money is supposed to be funding their retirement that they worked their whole life to fund is actually going to get to enjoy it without being worried about it breaking down at some point.
That's right.
Right.
And just to that point, what ends up happening is that many people, you can almost say on average, they end up dying with the exact same wealth that they retired. Oddly enough. I mean, there's data on that. So they retire in 1987 with X, and X spits off income, which they spend, and they die in 2000. And it's close to X. There's a lot of reasons for that. Basically, they retired because they viewed that as an anchor behaviorally. And I got to make sure that stays that way. And, first of all, that's not what a nest egg was meant for. That's not why they got tax breaks to save up that nest egg. It was meant to deplete and decumulate. It was meant so that we put less stress on government programs. I mean, there's a lot of reasons that the financial architecture has been built with a lot of, easy leeway, reduced taxes, deductibility, tax that, and all of that. So it should be spent. And then you get to that point and you're terrified to do it. So anything we could do to make that easier, I think is going to be very important. Yeah.
Well, absolutely. You can't take it with you, right? So,
but an important point, sir, if I can just, an important point is we're not suggesting that people need to spend all of their money and not look after, charitable bequests or pass money along to their children or whatever they want to do with their money. I think the key is that by removing that anchor that keeps you focused on the entire portfolio, you actually, we are creating tools that allow advisors to segment and achieve certain objectives, which actually frees capital up in an unconstrained way to achieve those other objectives. So instead of trying to take just one generic approach to, achieve all these things and having something sacrificed in the mix, we're trying to create these tools so that advisors can actually achieve the multiple objectives in different ways, which actually reduces the stress for investors, their clients, and gives them long-term confidence that they're actually on a path to achieve multiple objectives and not fear of everything.
Yeah.
Just to add to it, sorry, go ahead, Pierre.
No, I was just going to say it sounds very familiar. Like it sounds like capital efficiency. But in a manner like analogously, not. Sorry, go ahead, Doctor.
No, I was just going to say that I teach this course at the university called Retirement Income Models. It's financial advisors that want to advise retirees, and one of the first things I tell them is you've got to figure out whether the client that's sitting in front of you, the 63-year-old who's about to, there are two really major personality types. It almost bifurcates. One is someone who wants retirement income only. But the corpus of the capital they want to transfer to their loved ones, the charities that Barry talked about. They say to you, no, I only want to live on the income. Don't you tell me I have a behavioral problem. You have the problem. I want that money to go to the kids and the grandkids. Those are the people that want retirement income. There's another group of people on the other side that can't afford to have that preference. You're not going to be able to live off that. You can't afford that. You must decumulate or you will not be able to make it through. Or some people say, I don't really have anyone. I don't have children, grand. I don't want to give. I want to maximize my lifestyle. There's an entire die broke movement out there. Not die broke as in I want to die with no money. No, I want the last dollar to be spent on the last day. I want to have as much as I need until I want the maximum. You're a decumulator. Well, we have some conversations to have with you. But once we decide where you are you retirement income oriented or are you a decumulator? We can then talk about the right solutions for them and certainly talk about where guard path fits. Just to add to my mother-in-law, not to make jokes and all of that, but my mother-in-law is in the retirement income category. It would scare her to deplete wealth because she wants to leave that to, 18 grandkids and the charities and the synagogues that you want. She has absolute, and I tell her, but your standard of living is going to have to be lower because the income I don't care. We'll have tuna fish. It's going to the kid. So I'm not going to suggest that she, enter into a tontine scheme so that some stranger on the other side of Canada is going to get her money. It's an anathema. So we will bring that up with her. We're going to. But I think it's important to understand that we have to get to the personality that we're not imposing on people. We're certainly not telling people, you've got a problem, you're not spending enough. And that's not the way to phrase it.
Yep. Yeah. Yeah. You have to, as an advisor, you have to do the detective work at the beginning to find all this out before you start talking about solutions that bear a lot of explaining. So can we start? Let's start with the tontine first of all, because I think, on the surface, it sounds like a really delicious French pastry, but clearly it's not that. What is the origin of the tontine and how does it work? Yeah. How does that work?
Well, Pierre, kudos to you for pronouncing it correctly. You should see here how many people who just have no idea how to pronounce. We've had a lot of fun with that. So the tontine is a scheme that has hundreds of year history. And it's basically, here's the Twitter summary. It's a bunch of people getting together and investing in something, anything. a bridge, a hotel, a government bond, a parking lot, anything, and coming to an agreement, and this is key, that when they pass away, it's over for them. The rest of the survivors get it. That's it. You and I and someone, we're going to buy a toll road, and that toll road spits off revenue every single day, and whoever is alive gets to split it. But if you pass away, I'm sorry, it's going to the rest of the people who are still alive. That's it. A collective sharing the thing. That's the Twitter, the elevator summary. And it has been used historically as a way of raising capital that was more popular than stocks and bonds. There's a period in the 18th century where that's the way globally capital was raised. In fact, there are many, many hotels and coffee houses and bridges, if you go to the UK, that were financed that way. A bunch of people in a city would get together and say, look, we need a bridge to get over the river. We need the money. It'll generate a bit of a toll. Who's in? And they would say, well, how you doing? It's going to be a tontine. Whoever's alive gets, oh, that's great. And of course, as you can imagine, the mathematics is people pass away and that money goes back into the pool and the interest, you're getting better and better returns. You're winning, you're beating everyone. He just bought a government bond. I bought it in a tontine format, so I'm getting everything. So, it would by far exceed the income from anything else. And that excess would be called survivorship credits or mortality credits. That's kind of the historical concept. And, that's 300 years ago. Barry's got to tell you what's happened in the last 300 years. This is obviously, we're not buying bridges over the Thames River. That's not what this is doing. But, that's sort of the historical origin of it.
Yeah. And
I think the subject of mortality credits or survivorship credits is fascinating. That mortality, and I'm quoting you, Professor, which is that mortality is an interest rate, and that translates directly into a return for all the participants in the tontine, which is, by the sounds of it, it sounds like crowdfunding your retirement income.
Yeah, although I would use the language given your audience of this is uncorrelated alpha. Bingo. Yeah. It's alpha. It's hundreds of basis points. Yeah. Hundreds of basis points of alpha that is not just claiming to be uncorrelated with the market, and then we have a meltdown and everything goes down and correlations go to 100%, as happens over and over again during crises when liquidity dries up. You thought you had uncorrelated. This is uncorrelated alpha because nature has built things that biology doesn't care about the Dow.
Yeah, that's a fantastic point. Can we talk about a little bit more about the survivorship credits, the mortality credits?
Sure.
In terms of how that actually works. Just I know there's a clear-cut explanation, but maybe if you could sort of open up about that.
Yeah, sure. Happy to. And actually, I think it nicely bridges the historical tontine to the modern tontine as we have conceived and developed it, which is the bridge between the historical tontine and the modern tontine as we've conceived it is, we decided that it wasn't useful for society to build something that was a last person standing concept. And so we specifically designed the modern tontine to have a finite life with the clear objective of having a large group of people from any given cohort alive to benefit from it, 20 years hence. So that's a key differentiator between the modern tontine and the historical tontine. Ours is time limited and it's specifically designed so that, a large group of survivors can benefit from the pooling of their investment capital and the mortality risk 20 years hence. So that is a key, differentiator. And
yeah, that's fair. That's very interesting, actually. So now so basically you're saying if you survive the 20-year term of the tontine, of the modern tontine, then you would be on the receiving end of the division of the tontine's value.
That's exactly right. So 20 years, we grow so people invest their capital. And this is also as probably a segue into how the actual mortality credit element of the modern tontine works. So people invest their capital and that is invested on their behalf. And over that 20-year period, as people die, they forfeit a portion of their of that capital, of that pot that has grown over time, for the benefit of the remaining unit holders. They don't get nothing. So it's not like, again, like the historical tontine where, you die, you lose it all. This is a portion of what has grown over time is retained for the benefit of other people. And, so in fact, that discount over time, it grows, starting at 5% for the first 3 years, and then it grows by 5% per year for a number of years. And then, ultimately caps out at 50%. So, the goal is to not strip all of the value away from somebody when they die, but to supplement the investment returns of the pool with the mortality credits. So the mortality credits, very specifically, are derived from essentially that accretive effect when, if the person A passes away and they owned, they invested $100,000 and the pool has grown to $400,000. They pass away 15 years from now. 50% of it is retained. So all of their units are canceled, but the trust keeps half of that value. So 200,000 of the 400,000, and that's for everybody else remaining in the pool to share. And so fast forward over time, obviously, as that happens, and let's assume that there's roughly half the cohort that is still alive at the end to share, then you have this, compounding effect that on the net asset value, the assets stay in, the number of units decline. And so ergo, you've got a larger pool of capital, to share amongst the survivors.
Okay.
And just to add, sorry. Yeah, go ahead.
I was just,
Pierre, I'll let you talk, but there are two things I'll add later to what Barry said to tie into the behavioral side. But go ahead.
I don't know if this is a stupid question, but if I'm in the tontine and I pass away in year 15, does my estate get anything from the tontine? It does,
yes,
right? That's what I wanted to clarify.
So yes, so further to the example that I just gave, right? So if you invested $100,000, the value 15 years from now is $400,000, and you pass away, your estate gets $200,000. So in essence, what they only get in that illustration, 100% growth on their initial investment.
Right. That's perfect. Yeah. Thank you, Barry, for clarifying that. That's great.
I think it's important also for people to understand you're getting 50% of NAV. But that might be 100% of the money you put in.
That's right.
Don't mix up two things.
Right.
You put money in, you might actually get it back in 10 or 15 years when you die, or the estate. You're getting 50% of NAV, and if NAV has grown, right, I think that's important. And the other issue, you had raised behavioral earlier, and this is precisely why it was designed this way. In fact, that was part of the back and forth with Barry and I as we were starting. I said, no, I want people to die and lose everything. We need the highest possible mortality credits, like they did in 1722. And he said, no, nobody's going to buy that, Moshe. That's a great problem. Nobody's going to buy it. People are going to be afraid. We're going to have to give them something back, which dilutes a little bit the mortality credits. But you want to buy something, you want to build something elegant or something people are going to buy. And I think that was part of this. So that was the rationale.
Yeah, definitely elegant. I have to say, like, I'm sitting here thinking, while we're talking about this, because I hadn't even considered what we just got through discussing, which was that, I feel like if I'm in the tontine, I have so much to look forward to and so many reasons to look after my health and so many reasons to have more enjoyment in life rather than contemplating, what if I die before everything is spent? What if I outlive my money?
Yeah. There's actually, Pierre,
what if I outlive my money?
Yeah. Pierre, there's research that shows that. That isn't just something speculative that sounds like science fiction. There's research that shows that when you give people income for a period of time that is conditioned on them being alive, so it incentivizes that, not only do they use that income to take care of them, as we know, psychologically, there's something to live for. The fear is gone. I mean, there's a whole bunch of behavioral effects that we won't know for 20 years. But I can assure you there will be a scientific paper at the end of the 20 years when we wrap up the first cohort, and we're going to take a look at survivorship and effect. And, I think there's going to be a lot of the kind of things that you're describing.
Yeah, I can't wait to see what the results are of this experiment.
Yeah.
This great, this fantastic experiment that you're undertaking right now. it's truly amazing. Now that we've clarified some of the early points, I feel some excitement. I mean, that's putting it mildly. I feel very excited about, the idea that this solution is available, that people can actually opt for this kind of thing and have so much to look forward to rather than spending so much time in a feeling or a state of dread. Wondering, am I going to make it? And I think you've already answered the question, because one of my upcoming questions, and I think we've already sort of talked about, unless there's more detail that you want to share maybe I'm getting ahead of myself here, but I think the next question I wanted to ask you was, how does the decumulation strategy work?
Well,
how do you,
yeah.
And then the next question is,
yeah. That's a good, I'm sorry, I keep on interrupting, but I'm a professor. That's what I do. I think it's very important for Barry to talk about that, because my sense, having done a lot of media over the last couple of weeks, is that the Tontine is so innovative and different, as you pointed out. It tends to crowd out all the other great stuff that they're doing. There's protection strategies, there's options that are being used. So I'm glad you asked that. And, I'm hoping Barry can spend a bit of time talking about how we're creating decumulation. So go ahead.
Yeah. And so that's actually a perfect segue, because, so we've been talking so far about the Tontine, which is to try to create, let's call it a longevity hedge for that horizon 20 years and beyond, so that there's capital available to you. That there's going to be a pool of capital available to you 20 years to spend as you see fit in your later years in retirement. But there's the first 20 years, that horizon. So how do we approach that? And so that's why we developed the managed decumulation strategy, which is very specifically, to be clear, you put in $100, and our specific goal, the objective, is to have on 20 years from now, there be zero left. And so the challenge is, how do you try to manage a portfolio of assets to deliver consistent levels of distributions over a 20-year period? And so that's going back full circle to what I said about Guardian Capital. Guardian has, deep roots in managing portfolios that try to do exactly this type of thing. And so it's a combination of asset allocation, both strategic and tactical, but also overlay strategies, which actually help protect against material drawdowns, particularly early on in the portfolio's life. So managing, as you mentioned earlier, Pierre, that sequence of returns risk, which is so critical and frankly either misunderstood or underappreciated as a danger to people in retirement. That we know mathematically that, everybody benefits from, dollar cost averaging on the way on in accumulation. Well, when you take money out in down markets, it has there's a multiple factor of the benefit on the way down. So it's very dangerous. So that's why we've structured the portfolio and the management of it the way we have with our teams to implement strategies that actually, try to deliver that smoother return without material drawdowns, to ensure that the portfolio lasts and we can, achieve the objective of consistent distributions over time.
So now I noticed you have three components that are part of the of the suite of solutions, of the longevity suite. You've got the decumulation strategy, and then you've got on the other side the Tontine, and then in the middle you've got the hybrid strategy. Correct. Which is the combination of the decumulation strategy and the Tontine strategy.
Correct.
Combined.
Yeah,
right? Correct.
And so to be clear, so as we talked about earlier, there's really two distinct challenges: that high income and that fear of outliving the portfolio. And so we're trying, the two solutions address them separately, but oftentimes they're interrelated and they're coincidental. So that's why we have them separated into separate vehicles. However, in our research, we ascertained that a single solution that actually combined the two of them would be most convenient for some types of investors and advisors. And so the hybrid Tontine series of the managed decumulation fund, instead of, and so bear with me as I back up just a half step, the managed decumulation F series is striving to achieve an 80-cent per year distribution over 20 years. Okay, so that's your baseline. And then with the hybrid Tontine series, what it's doing is instead of paying out all 80 cents to you in cash, what it's doing is it's taking 15 cents of that 80-cent distribution. So you're still getting 65 cents that's going to your spending needs, but 15 cents is being systematically invested through a switch mechanism into units of the Tontine Trust on your behalf. So you actually are, you're getting cash flow, and you're also getting an investment along the way in the Tontine Trust. And so that is done for you. So for some people, it's a very elegant way to achieve both, to try to solve both of these challenges for them. But if you say, well, I really only need, I want 7, I don't want 6.5, then, you can take the 8% and invest, the 80 cents and invest, 10 cents per year in the Tontine yourself. It's just intended to be a solution where we execute it on your behalf.
Right. So that was one of the questions I was going to ask, was that either of the two main components, either of the decumulation strategy or the Tontine, can be used separately?
Absolutely.
They don't have to be. I mean, the hybrid is the middle ground, the fusing of the two solutions that you provide.
Sure.
But otherwise, I mean, I guess an investor is free to use the Tontine in conjunction with any of their assets.
Yeah, absolutely. Somebody may, so I'll give you 2 different examples. And Moshe, I'm sorry if I'm dominating this. You feel free to an example where somebody who has ample capital, they're not, and by the way, they're not north of 60, they're 50. And they have tons of capital, so they're not worried about how much money they're going to have when they're 85, because they've got lots of it. But they really like they like the approach of investing a portion of their money into a decumulation strategy, which gives them some surety, some relative assurance around those cash flows. And then that just frees up capital to invest in whatever else they want. So that, one example. The other example would be, I don't want to actually take any risk with my, zero risk on the cash. I like a cash wedge, and thank you very much. And I'm going to invest it in GICs, and that's going to be the source of capital. But I really like this concept of making sure that I've got some money available to me when I turn 80, when and if I turn 85. And so, boom. So I just want the Tontine. So they can be used, completely separately. Oftentimes for lots of investors, those challenges converge, right? Because, so this will probably be obvious to you, but in this day and age, trying to generate the income that we need in retirement for the average person, what's happening is that they are focused on trying to generate that level of return from one portfolio. And in order to generate the return they need, they've got to take a whole bunch of incremental risk in order to achieve it.
Absolutely.
So they go way up the yield curve, way down the credit curve, or a whole bunch of equity risk, which of course, paradoxically, increases the likelihood that they're going to outlive their portfolio. So by having these tools, it allows them to address one aspect, both aspects, or all of it, depending on their needs.
Yeah, absolutely. I mean, chasing yield, it's not hard to understand when you consider that, a 2% income, let's say a bond, let's say the average fixed income yield right now is 2.5%. On $1 million, that's $25,000. It's not really a living income.
And that's nominal, not real. That's nominal, not inflation adjusted. So your real return is negative. It continues to be negative. Feds raise rates, you're still earning a real negative return. And mortality credits aren't nominal. Mortality credits are real. So I think it's very important to understand that what is being created here isn't something that isn't going to look attractive once interest rates are 8. You'll always want 300 real basis points. 300 nominal basis points may not be exciting, but real basis points. I think that's important to differentiate the inflation story now. I mean, when we started on this 2 years ago, we didn't think that we'd have to talk so much about inflation 2 years out, but I think it's important to emphasize that. I think another issue, and Barry and I have a side bet going as to which one's going to be more popular, and you touched on this, Pierre, earlier. Are people going to say, once they understand the tontine, before they understand the tontine, it's a fog. Once they understand the tontine, are they going to say, I'm in, here's 100,000, see you in 20 years, tontine trust? Or are people going to say, you know what, I think I'm going to buy this slowly. I'm going to buy this over time. Hybrid tontine. So I won't tell you what side of which bet Barry and I are taking. That's something else. But we have a bet on which one's going to...
I find the uncorrelated alpha angle very attractive. I think being able to put something like the tontine as a component of a portfolio construction as an uncorrelated alpha is a very exciting opportunity for investors, just like collectibles or art. I mean, if you're buying art, you're buying collectibles, you're buying other alternative types of assets, or, straight alternatives, not necessarily derivative alternatives, but if you're buying straight alternative assets, that fits really nicely into a portfolio construction as well. So there's so many ways that these components can be used as tools, not just a straight investment program for retirement income. But that's a whole, maybe that's a whole other discussion. Is how,
as long as you don't compare us. As long as you don't compare, this to NFTs. I was afraid that was the next statement you were going to make. NFTs. I'm like, oh man, no, we're not going there.
No, it's a source of uncorrelated return. And, obviously it's accretive, in the long term for investors. And so that's, clearly a differentiating factor of, for example, people would say, well, okay, I get it. Like 20 years, it's so I'm going to just invest in a long-term equity fund for 20 years and don't I end up in the same place? Well, no, that's correlated with everything else you've got. You don't have the accretive effect of the mortality credits, and you don't have the uncorrelated effect of the mortality credits.
Right. So
I think for many years, just to understand the innovation here, how the insurance industry has had a monopoly on mortality credits. You think about it, because somebody will say, wait a minute, isn't that just a defined benefit pension, life annuity? But why should they be the only ones that can do mortality credit? Yeah, they may have a monopoly on guarantees because of the insane amount of capital that they need, and that obviously translates into the OES. But why should they be the only ones that can do mortality credits? We want to do mortality credits. And I think that's what we're trying to do here, to separate mortality credits from guaranteed lifetime income. Those are two completely separate things. You want a guaranteed income to the age of 50, go buy a portfolio of strip bonds. But you want mortality credits, you should be able to do it in a security setting as well. I think that's the way I, as an economist, would say it. Could be the lawyer, and Barry would cringe in the way I've just explained it, but that's sort of the way I view it.
No, I don't cringe. I just think, though, that it's very important to point out that we are not an insurance product. There are no guarantees associated with what we're doing, right? It is an investment solution. We've structured it as such. They're all regulated, under the CSA's policies, National Instrument 81102 for mutual funds. So, look, these are investment funds, and, they are investment objectives. There are no guarantees. If you want a guarantee, then you need to go to, the insurance company, right? But we similarly, the flip side of that coin is we don't have to have the capital reserves and all of the expenses associated with a guarantee. And so we can hopefully deliver both a higher level of consistent income on the decumulation and a higher overall rate of return on the tontine, because we're not burdened by those expenses.
So we give you the full alpha. I think that's very important to understand. They can't give you the full alpha because they've got to set aside all of that, because they've also guaranteed you something. We're separating it.
One of my questions was going to be, I think we've already answered it, but maybe there's a couple other details that we can touch on it. But tell me if I'm wrong. But my question was, how is this different from annuities?
Yeah.
And
so just to be clear, to be clear, we have nothing against annuities. Yeah. I mean, some of my best friends are annuities. Don't get me wrong here. Annuities have an important role to play in the retirement portfolio. If you take a look at anything I've written in the last 25 years, what I'm saying is that we just have to make sure that people understand what are you buying when you buy one of those. And we happen to understand something called the annuity puzzle, which is the fact that thousands of economists, thousands, not hundreds, are scratching their heads saying, why are people buying this thing? Why are people going out and buying the life annuity? And the reason is many of the behavioral obstacles and tendencies that. So we're not sort of saying this is better than, or this is an alternative to, that's not what we're saying here. And I think Barry hit the nail on the head. This is not guaranteed. Please remember that. I have no idea how many people will survive 20 years from now. I have a rough estimate. I can certainly give you confidence intervals, but we're not guaranteeing anything. We're certainly not guaranteeing that 80% will survive. That's a scary thought. No matter what happens, we make sure only 80%. If there's extra people, we'll make sure they're not around. That's not what we're saying.
I think it's I don't think we're not here to they're all different. All these things they're all just different tools. The more tools you have in your toolbox, the more solutions you can provide. I think that's the key here. And that's, I think one of the problems in the financial industry is that, has been historically has probably been the training that happens across the industry. And so without putting anything in particular down, I think depending on who your mentors were when you came into the business as an advisor, or how they were trained, or where they trained, who trained them, what company trained them, what was their training ground, you're going to get all these different biases that create, negative impressions on things like annuities, on things like whole life insurance, on things like, a variety of different products that once were very popular and now are no longer popular. But the funny thing is that everything comes and goes in cycles, and suddenly a lot of products that were not popular for obviously, and maybe even for obvious reasons, for the last 15 or 20 years or longer, is because the stock market was very popular. And, we had, this 12 years of quantitative easing and low, interest rates falling for 40 years. But we're going in the opposite direction, or we're starting to head in the opposite direction. And I always ask, I always wonder, how long is it going to take for advisors or for the industry to right that ship, towards guiding, retail clients, retail investors to start to really make some substantial changes or allocations to assets that aren't going to get, keep getting hurt by the change in the regime. How long does it take for us to let go of those historical biases that, we've had 40 years to get used to it, and now we have to get unused to it. So I love where like the adoption of new ideas comes in, and I love the angle on the uncorrelated alpha, Professor. That's fantastic. That's a fantastic insight.
And just Pierre, just to add, I know we're winding up here, but just to add to your comment, it's not just that we now have an end to the 40-year decline in interest rates and the 8 years and what. We now have that in conjunction with the fact that people in their own life are going through a transition, which is from accumulation to decumulation.
Absolutely.
So it's the intersection of those two is really where this is coming in. It's not just we need to think differently because, the Fed is running things different. It's like you're in a new stage of life during that traumatic episode. What are we going to do?
Yeah. And
well, I'm thankful. And
sorry, just to add to the hopefully rounding out the picture, to your point, Pierre, these are tools that are intended to be used as part the overall planning process for retirees. And the reality is that we advisors perform an incredibly valuable function, right? And so what we want to do is just make sure that they have the necessary tools to plan properly for the different types of clients they have. So, to your point, you think about somebody who just started decumulating this year, right? They've got a 40-60 portfolio and they started decumulating and they have had massive drawdowns. The stress that they, might be subjected to, associated with, geez, oh my goodness, do I have to stop taking money out? Do I have to, so again, just providing people with some additional tools so that they can actually create these long-term successful, strategies that help to ameliorate those worries.
Sure. I mean, if you're down 25%, you have to come back 33.3 to get it back. And so if you're withdrawing from the 75% that you have left after the correction, you're further crippling your recovery by taking money out of the pool that needs to have a multiple greater recovery.
Absolutely.
And down 50 is 100, right? I mean, people forget these ratios, but if you're down 50% like March 9th of 2009, or March of 2020, we were down 37%. Markets were down 37. I mean, those are huge numbers to come back to. I mean, and that's largely where the sequence of returns risk lies, is in those drawdowns.
And the role, and just to add, the role of put options, which is a word we haven't used yet, the role of put options of enabling you to truncate that at the expense of upside, because you have to pay for those puts by writing some calls. I think it's incredibly important in retirement. We can't be greedy. We don't want to lose more than a certain amount in it, right? We want to, but at the same time, you're going to have to give up some upside. And that trade-off is completely unappealing to the accumulator. When I'm 20 years from retirement, I'm like, no, I'm not interested in that trade-off. I want full upside. And yes, I understand that means some downside. I don't have to touch this. In fact, I'm adding to it. So don't even talk to me about protecting collaring. Once I'm in decumulation, that is a very attractive proposition. And I always just baffled by the fact, why aren't people using options to do this? Well, because, you're talking about mom and pop here. Well, now this is put into an aggregate structure. I think that's an important angle that, again, sometimes gets lost because everybody's so excited about the tontine. Like, wow, it's not, let's not forget there's a lot of other innovations here. Honestly, this could have been launched without tontines because of all the important decumulation things that are going on. Let's not lose sight of it.
Yeah, very important.
So what was the wager? No,
our lips are sealed.
You'll have to wait 20 years. 20 years.
Yeah,
we will
to
disclose
Moshe's point on just the.
All right, so
that's right.
Barry, where can advisors and investors get more information about GuardPath?
So look,
and about the loan. Yeah.
So the a very simple way is, www.guardpath.ca. That takes you to the website that has, a whole host of educational materials and product positioning materials. In addition to that, obviously, we have tons of people who are dedicated to interacting with advisors and educating them on these solutions and how they can be positioned, the use cases, how they can be used in client portfolios. And so, if an advisor has a contact already at Guardian, then great, reach out to them. If they don't, contact us and we'll connect you with the right person. That's probably the easiest.
Wonderful. Well, gentlemen, thank you so much for your time and your insight. So honored that you could be here with me today to talk about this. What was the hashtag? Revolutionize retirement.
Yes. Yes.
This revolution in retirement planning. I think it's very exciting. I think a lot of people are going to be excited, rightly excited by this innovation that you've brought to market. Thank you so much for your time. And Professor Milevsky, honored to have you, and Of course, Barry,
Thank you
as well.
Thank you.
I echo that sentiment.
Yeah, I'm kidding. I'm just kidding.
No,
Both of you.
sure.
It's been an honor to have
Thank you.
absolutely an honor to have
Thank you.
both of you
Yeah.
on. Thank you so much for
Yeah.
that.
Thank you very much.
Thank you, Pierre.